Hey everybody, this is Greg Gossett, and today is Saturday, September 17th, 2022, and this is the weekend edition of the Gossett and Trading and Mentoring Podcast. It's the weekly review where we're going to go over and take a look at the trades that I had this week, how I managed them, and we'll get into all that. But thank you so much for coming by. I hope you're having a good day. I hope you're having a good weekend. I hope you're staying safe. In last week's market, my goodness, a lot of volatility. Market going down, volatility going up. So I hope you're staying safe out there, following your process, position sizing correctly, and doing what you're supposed to do. In trading, we don't always make money. There's times where we have drawdowns, and if you're long, it's been tough to make money in the last week. But I do see some potential light at the end of the tunnel. I'll go over why I say that when we start going through the chart. So here's the plan. Like I said, first of all, we are going to run the U.S. legal disclaimer. Secondly, I'm going to come back, take a look at my current positions that I was active with last week. And we're going to talk about when I bought them, why I bought them, and how I am going to manage them going forward. After that, we are going to talk about a little bit about trader psychology. Most important part of trading is the ability to create a plan, follow your plan, and not let the emotions amplify so that you don't follow your plan. It's very important, everyone. So I always like to touch on trader psychology because it is such a major part of trading. It really is the most important skill in trading, is the ability to manage your emotions, especially when things get tough. I know some traders, when things are going well, man, they're perfect, they're spot on, they do exactly what they're supposed to do. But when things are going badly, the reptilian part of their brain takes over, and they get into fight or flight, and a lot of times they fight, and not really a good thing to do. All right, so after that, after the psychology section, we are going to do a quick poem from my good friend Frank. Frank's a great poet, obviously, great journalist, great musician, and he writes poems every day about the market and what's going on. I think it's always pertinent and helpful, so we'll get to that. Then I have gone down through my watch list. I have selected about 18 different potentials for next week. When the market goes down like this, it's never fun if you have long positions, but I do believe it gives us some opportunity to buy some great stocks at a good price. Of course, we have the FMOC meeting next week. I think that's going to obviously affect things. I'm bullish right now, to be honest with you. I am bullish, and when we go through the charts, I will explain why I am bullish. But we'll go down through each of the stocks that I selected. What I'm looking for the individual stocks either to go up, maybe with some momentum signals, or to go down and look for some deep dip buy signals as well. So I think there's some opportunity for next week, and so we'll go through each one, and I'll tell you what I'm looking for, and after that, I guess we'll be done. Yep. So that's the plan for today. First of all, I do have to run the U.S. legal disclaimer, so hang tough. I'll be back in about 40 seconds. Thank you. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. All right, thanks for sticking through that with me, and let's get to current positions. So I'm going to go over the closed positions first. First position that I had, which was a losing trade last week, I did buy NET Cloudflare. I bought this back here on the 14th of September, had a nice higher low V1 Also had a close under, close over the 50. And I like this trade. I like this trade a lot. I did get in at 61.22. Of course, I always place my emergency stop 2 ATRs below my entry, so I have a defined risk. But my end of day stop was a close below halfway of the washout bar. So this is a V1. V1 consists of 2 bars where you have bar 1, bar 2. Bar 2 went under bar 1 and then closed above bar 1's close. So the price went down here, tested the prices down here, didn't like it. It's a good information to have, and then closed higher. My stop on a V1 is a close below halfway of the washout bar, and the washout bar was the entry bar that I took the trade. From a Fibonacci standpoint, should not close below 50%. So I did stop out of this. You can see the pink line here is halfway of this bar. The next day after the trade, it did go up a bit. I was fortunate to take off 10% of my position size at a profitable level, and that's why I like to take partial profits whenever it moves up 0.45 ATR value from the previous day's close, because this exact kind of thing can happen. It can move up and then ultimately come down and give you a loss, but whenever it moves up a certain amount, I like to take it. You know, when the market gives me something, I'm going to take something, not the entire position, but I am going to take off not half, but a partial 10%, and better than nothing. And this is a good example of why I like to take profits, because obviously this mitigated the loss to the downside because I took off 10%. Didn't mitigate it a lot, but it mitigated something, right? And so here on Friday, we closed below halfway the washout bar on the day that I took it, and I had to exit the trade for a 3.52% loss. All right, Coca-Cola. Well, Coca-Cola is another good example of taking profits. I did buy Coca-Cola back here on the 6th of September with this bounce off the 200-day moving average and off of the negative third ATR channel. Got long here 61.11. Actually, we have a dividend. We had a dividend, so it messes up the actual prices, but you get the idea. But I went long here 61.11. It moved up the next day. It was profitable. I did take partial profits off, right? Took 10% off. Next day sideways, next day went up again, took another 10% off. So this is a good example of this ultimately ended in a loss, but I did take 10% profits here, 10% profits here, so that when it did actually come back down, close below the 200-day moving average, I did get out. So this has changed because of the dividend, but the actual prices, I got in at 61.22. When it closed below the 200-day moving average, I got out at 60.46. So small loss, 1.06% loss. And remember, not all trades are going to be positive, right? But the profitable math equation in trading is you can have big winners, obviously. I recommend it. Number 2, you can have small winners. That's fine. You can have break-even trades. That's fine. And you can have small losses. The calculus, the math calculus for trading allows all of those outcomes. But what you have to stay away from is you have to stay away from the large losses. Those are the ones that really impact your account financially and also your mental capital. Think about your trading. When did you make the worst decisions? Probably when you were in a significant drawdown, I would bet. So keeping those losses small, they're never fun, but that's the equation for profitable trading. Small losses are allowed. So again, took the trade with a bounce off the 200-day moving average, 61.11, moved up, did take some profits. With my offensive approach of taking profits, 10% off when it moves 0.45 ATRs. Then on this was the day here, the big down day where I took, where I got out at 60.46. So an exit of 1.06% loss. Now I do have Coca-Cola on my list of potential stocks to look out for next week, and then I'll go over those when we get to that section. All right, VIX. Oh, well, shoot. Dang rules, right? And this is what's going to happen. But I did go long VIX on the 9th of September. We went under 30, over 30. We had a V1 entry. I really liked this entry here. I got in at 1847. under 30, over 30, but the next day closed below the 30 RSI. I had to get out for a, what is that, 1.6% loss, and I got out, and then boom, right back up. So I had the right idea. I was off, my timing was off by 1 day, but that happens often. But it could have just kept going down, right? And again, taking your small losses is the key. When you hold on to a long loss, it's such a horrible feeling if you're short and it keeps going up and keeps going up and keeps going up. Even if it eventually comes back down, you had to go through all that heat and all that discomfort. You know, after trading for 28 years, really the easiest thing to do, and my best advice for everyone, is if you have a loss, get out quickly. It's going to sting a little bit, but you're going to forget about it the next day or later in the day if it's a small loss. But if you hold on to a major loss, it's going to affect you, and it is not fun. So anyway, did take a loss of 1.6% on VIX. Then I had to watch it go up, but that's just part of trading. All right. So those are all closed trades. Twitter. Now, I really like this Twitter trade. I did buy this Twitter trade back here on the 13th of September. We had a liquidity run and a structure change. Here's the low. We ran it. We took out this high, which puts this chart into a bullish market structure. And this is something new that I've been learning as far as market structure from the Inner Circle Trader on YouTube. I would really suggest that you go and subscribe to this channel and watch it. There are so many videos, and it is really good stuff. My very good friend Ava turned me on to this approach, fair value gaps, order blocks. Really like it. So if you'd like to learn more about that, go to the Inner Circle Trader. Go to videos. I would suggest watching videos 3, 6, and 9 first. So anyway, big picture here, like I said, we did run liquidity here. We broke the market structure to the upside. And then what do you want to do when you break market structure to the upside? You want to buy the dips. If you break market structure to the downside and get into a bearish market structure, then you want to sell the rips or sell the rallies. So I like the confluence of what happened here. Liquidity broke the market structure. That created a fair value gap between this bar and this bar. Again, this is ICT material, but if you throw in Greg material, we had a confluence. We had a pullback to the 200-day moving average at the same time we were in this fair value gap. Usually I wait till the end of the day to make my swing trade decisions, but in this particular case was a little unorthodox for me. But as we got down to the 200-day moving average, in addition to being in the fair value gap, I did buy Twitter right here at 40.62. Again, because of the positive market structure change, pull back into the fair value gap, and on top of that, support at the 200-day moving average while MACD was green. And on top of that, the relative strength of Twitter has been extremely strong compared to the rest of the market. And, you know, when I day trade, what I really like to, my big picture of day trading is if the market's down, I look for the stocks that are the strongest and have the best relative strength, and those are the ones that I want to concentrate on during the day to get long. Conversely, if the market is up and you have a stock that's weak, relatively weak, those are the ones that I like to concentrate my shorts on. So anyway, did get long here, 40.62. As it moved up, again, of course, taking partial profits, 0.45 ATR profits. And this particular trade currently up 1.86%. So very grateful for that, especially considering what the market's done. Verizon, I did get long Verizon yesterday. I should put that in here. 9/16/2022. All right. And I really do like Verizon. I like this double bottom with the bullish divergence. See how we have this low? See how we have the reading of the MACD, the deep red MACD bars? This MACD is a momentum indicator. So we came down with pretty significant MACD. We rallied strongly into green MACD. Now we came back down. Yesterday we tested the low of this previous low back here on the 8th. But see how there's no red MACD? that is showing that there is a reduction in the momentum to the downside. Even though we came lower from a MACD standpoint, this second leg down here was not a strong leg down from a momentum standpoint. So the implication of that is that we are running out of sellers, and therefore we may be going up. I studied one-on-one with Dr. Alexander Elder. This is his bread and butter, these particular trades, these double bottoms with bullish divergences or double tops with bearish divergences. So even though you have a double bottom with a bullish divergence, it doesn't mean you just automatically go ahead and buy. You still need some kind of entry. And Verizon bounced right near the 30 RSI, came up, had a bullish engulfing bar here. I do like this. 34.83 is the RSI. So I did get long at 41.12. It's 41.25. Look at the volume also. So I placed my emergency stop always 2 ATRs below my entry. ATR, I just have the reading here of 141. So I take my entry, put my emergency stop 2 ATRs below it. And just from a position sizing standpoint, let's just go over this and I'll show you how. So a good rule of thumb is 1% of your total capital would be your maximum allowed loss. I always have two stops in my trading. I have an emergency stop and I have an end of day stop. All right. But I always want to go with the worst case scenario. So let's just say hypothetical $100,000 account, 1% of that is $1,000. If you had a $500 account, 1% of that would be $500, right? If you had a $25,000 account, 1% would be $250, all right? So for this hypothetical, let's just use $100,000 and a 1% maximum allowed loss. 1% of $100,000 is $1,000. So from a position sizing standpoint, I would take that $1,000, I would divide it by the value of the 2 ATR. In this case, it's 141 divided by 141 would tell me to buy 709 shares. Now, so that's how many shares I would buy if those were my numbers. If 709 shares moves $1.41, how much do you lose? Well, we just did the math, $1,000. Now, am I really risking $1,000 on this trade? I am in the worst case scenario, but 95% of the time, I am going to hit my end of day stop, not my emergency stop. And why did I get into the trade? Well, we bounced right near the 30 RSI along with this double bottom bullish divergence. So therefore, my end of day stop is if the RSI closes below 30. And if it closed below 30, most likely it will be above my emergency stop. So your end of day stop, 95% of the time, you're going to take the smaller loss, but you still have to account for your maximum allowed loss. And again, the way I do that, 1% of my total capital divided by the value of the 2 ATRs shows me how many shares to buy for me to have that emergency stop number. So this one up a little bit. I guess I should technically do that. Let's see. So from here to here, up 0.32% on the trade. So I will take it. But I like this. I like the double bottom bullish divergence, the bounce near the 30. MACD is positive. And look at the volume that came in. Wow. And relative strength. It was up when the rest of the market was down on Saturday. And it does, Verizon, I think, pays like a 6%. I think Verizon pays a 6%. Yeah, 6.2% dividend. So really like Verizon. Now, next trade, NVIDIA. I did buy NVIDIA on Friday. This is a weekly trade. I like to day trade. I like to take end of day trades. I like to take weekly and monthly trades as well. But look at NVIDIA. Really, really like this. We came all the way down to the 200-week moving average, and we bounced. So it did show some support there. We also have a double bottom bullish divergence. I was just explaining that. But look at these lows here. Look at the deep red MACD bars here, showing that the momentum was strong to the downside by the deep red MACD bars. We did rally. We created some green positive MACD, which is required for this approach based upon Dr. Elder. And then on Friday, look, we came back down. We made a lower low, but look at the MACD. not very deep. Again, this is showing that this leg down here did not have the selling momentum as this first leg did over here, identified by the deep red MACD bars. So what this is telling me is that we found some support at the 200-day moving average. We found some buyers there. The selling pressure is abating, and the implication would be that we would be going up. Now, of course, it doesn't have to go up. So here we go. Let's do this one real quick as well. So remember we were talking about, now this is a weekly, and sometimes I get questions, people say, well, is it a different position sizing from the weekly, from the daily? No, it's exactly the same. Let's take the $100,000, 1% is what? $1,000. And then we divide the value of the 2 ATR on the weekly charts. Well, of course, the value of the 2 ATR on the weekly is going to be much higher because there's so much more movement in a weekly move compared to a daily move. So you're going to have fewer shares, but you're going to be in it for longer in a weekly, so you have to adjust for that. So 1% of 100,000 is $1,000 divided by the value of the 2 ATR divided by 41.33. It's telling me to buy 24 shares. Not a lot, but if 24 shares moves 41.33, how much again is it? $1,000. So it works on daily, intraday, monthly. It's a great way. It's a great way to position size. So, purchased it, placed my emergency stop 2 ATRs below. Now, what do you think my end of week stop's going to be? It's simply going to be a close below the 200-day moving average. Next Friday, if it closed below the 200-day moving average, I just have to go ahead and get out. On Monday, if it came all the way down to my emergency stop, what would I do? Do I wait for the end of the week? No, because it hit what my emergency stop was, the 1%. So always 2 stop losses in my style of trading: emergency stop, end of day stop. But I really, really like this trade because of the double bottom bullish divergence, the bounce at the 200-day moving average, and we're at a 35 RSI as well. So in at 131.97, it's 132.01. Let's take a look here. Yeah, so basically break even on the trade. So that's it. Took a loss on Net, Coke, VIX, and then have profit in Twitter, Verizon, and about break even on NVIDIA. But I'm very grateful that I did have some positive swing trades, especially in light of last week's down move in the market. All right, so before we start looking at my potential trade setups for next week, let's go ahead and do a little trader psychology before we get to that. And this is from one of my favorite, gosh dang, excuse me. You know, I had COVID a few weeks ago. I still have that tight cough, so I apologize. One of my favorite channels on Twitter is the Divergent Trader, Alan Edwards, and you can follow him at Trader Divergent over on Twitter. Great posts. They're very succinct. Always look forward to these, and that's why I share these a lot. 7 deadly trading sins. Well. I've done them all. I admit I have broken all of these rules, and I try my very best not to. I am not an angel when it comes to my trading. I do the best I can, and I always talk about teaching what you most need to learn, and that's probably why I teach about trader psychology. But what he says here is right. I've done all of them, and I do my best to follow my rules and not sin. Don't sin when you're trading, but sometimes you have the angels and the devils. But honestly, I mean, from the bottom of my heart, try not to do these things. Your trading's going to be better. Your results are going to be better, and that's why we trade, right? All right, number 1, over trading. What's over trading? It's when you trade too much, when you're not being patient enough, waiting for proper signals to get in, to get out. You just want the action of it. I've done it, no doubt about it, but honestly, let the trade come to you, everyone. Warren Buffett always says there's no 3 strikes rule in the market. He's referencing baseball. You can sit there and be as patient as you want and just wait for the proper trade to come to you. Look for the support levels, good risk to reward ratios. You don't always have to be in there trading. So number 1, trading. Copy trades. Well, copy trades is when you're copying other people's trades. right? Like, that's fine. A lot of people do it, but really at the end of the day, you need to be able to go in and do these things for yourself, right? You need to be able to learn to do them for yourself so you do not have to rely on them. And I guess a decent place for me to mention this, I'm going to talk about it at the end of the podcast as well, but I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course. I think the best way for anyone to learn anything is to have a one-on-one teacher and mentor, and that's why I provide the lessons in this format. I've taught people from all over the world and have turned out some really good traders. So if you're interested, there is my email in the link of this description. Just send me an email and we can get the process started. But I want you to, the important part is that you learn to be able to do this by yourself and not have to rely on anyone's trades. No trading plan. Well, that's quite obvious. You need a plan. Where am I getting in? Where am I getting out? How many shares am I going to buy? What's the volatility? That's what I was just showing you with position sizing with the 2ATR. Where's my emergency stop? Where's my end of day stop? Where am I going to take profits if it goes up, and how much? And where's some overhead resistance levels? You need a plan, everyone. You need a plan. And there are so many easy trading approaches. It all comes down to risk to reward, buying at support, getting out quickly when you're wrong, having the courage to stay in when you're right. You know, one of my favorite sayings is you have to be very impatient with your losers and you have to be very patient with your winners. Unfortunately, most traders do the opposite. If it goes down, they get very patient. Oh, it'll come back. It'll come back. You know how many times I've heard that? Oh, it's going to come back. A lot of times it does. Sometimes it doesn't, right? But they get very impatient with their winners. They get a little winner. Oh, I need to take that because it feels good, right? That's why so many people lose money trading. It's counterintuitive. You have to do the opposite. You have to be very impatient with your losers and get out quickly. And then you have to be patient while you're in the money. That's it. Blaming the markets. Oh, yes. Tried and true. Blaming the markets for your losses. Well, yeah, of course it's a market, right? But if you followed your plan, even if you've had a losing trade, you don't have to blame yourself. Congratulate yourself that you followed your plan, right? We all know how it is. You're supposed to get out. You don't get out. Keeps going down. Yeah, then you can blame yourself. But if you followed your plan, don't blame yourself. Congratulate yourself that you followed the process. Switching strategies. Also, been around a long time. Hey, this V1, V2, it's not working, but this other approach is working. What do? You switch to that one, then that stops working, and then the V1s, V2s start working. It's like being in traffic. You're in this lane, it's not going. You look at the next lane. Oh, that one's moving. Oh, I got to get over there. As soon as you get over to that lane, what happens? It stops. The lane that you were in starts going. You know, it's fine to trade different strategies. As a matter of fact, I'm a proponent of it. But don't just impulsively switch strategies because one's losing and the other is winning. No risk management. Do I even have to talk about this? Apparently I do. You have to have a defined risk on your trade. 85% of the time, if you don't have a risk management, it'll probably go your way, to be honest with you. But there are going to be those times where you are going to have a stock that just keeps going down and down and down and down. And if you don't take a loss, one day you're going to take the mother of all losses. Back in the early 2000s, I went through this. I know of what I speak because I have experienced this. I didn't have a stop loss on, oh geez, let's see, WorldCom and Enron. Was that a good idea? No. Those of you old enough and have been trading back then, you understand. I lost over $1 million in like a month and a half. Right? So yeah, I'm pretty passionate about this particular deadly trading sin. You have to have risk management, everyone. Trust me. Most of the time, sure, it's going to come back, but there will be times where you run into Enrons and WorldComs and maybe FedExes, right? Speaking of something that is time sensitive that happened yesterday, of course. And then lastly, not working on their psychology. Psychology is what trading is about. When you look at a chart, what are you seeing? You're seeing people's psychology. Buying, selling, psychology is the most important part, and that is why I do this. How do you work on trader psychology? Well, you know, when I get done trading, every day I go for a walk. I visualize and I go over how I traded that day, what I could have done better, what I did right, what I did wrong. I do meditation. I do visualization of my trades. When I visualize getting to a stock, and then if it goes below my end, gets to my stop, I just get out. I don't care. Boom. But there's, deep breathing, exercise, eating well, sleeping well, visualization. When I walk, I always do a little mantra where I say, I attract positive trade setups. I know it sounds a little corny, right? But what can it hurt? And as I walk, each foot with each word, I attract positive trade setups. Actually, I say I am a magnet for positive trade setups. Works pretty well. So 7 deadly trading sins: over trading, copying trades, no trade plan, blaming the market, switching strategies, no risk management, not working on their psychology. Any more? If you have any more that come to mind, put them down there in the comment section. But thank you very much, the Divergent Trader, Alan Edwards, and follow him at Trader Divergent over on Twitter. All right. Now, before we get to the charts, just want to do a little trader psychology for my good friend Frank. Please follow Frank at FrankOD over on Twitter. Today's market poem: ouch. The punches a trader must take. Who says everything is baked in the cake? In good times, profit come in with a rake, or it can squeeze like a snake. It's work just keeping the money you make. Very true, as most of all of Frank's poems are. Actually, this has been a tough market. This has been an extremely tough market. I mean, we have the Fed rising interest rates into a recessionary type scenario. We have the best of the best stocks going down. But again, as I mentioned, I think there are some opportunities here at these low levels with the best stocks in the world. If I were you, of course, not giving advice here, but just kind of speaking from how I see things, I would not be messing around with, the Virgin Galactics of the world, the Teradynes of the world, the Zoom of the world, the ARCs of the world. I would be focusing on the biggest and the best companies that are on sale right now. Studying with Dr. Alexander Elder, he's like, look, everyone likes a sale except for stocks. For some reason, people just want to buy stocks when super retail. They want to pay full freight on the best stocks in the world. They only want to buy when they go up. Well, you have Apples, you have Googles, you have Microsoft, some of the biggest and the best companies in the world. The way that I look at trading right now in these kind of market environments, not getting involved with anything but the biggest and the best companies and buying them on sale. So one more time, ouch. Ouch. The punches a trader must take. Who says everything is baked in the cake? In good times, profit come in with the rake. It's true. Or it can squeeze like a snake. It's work, just keeping the money you make. And, this is a difficult time in trading, so you have to be extra careful, but there is opportunity here as well. Okay, here we go. Let's get to the potentials for next week that I'm looking for. Speaking of some of the biggest and best companies on sale right now, here is Apple. My gosh, a few weeks ago we were at 175, now we're at 150. Look at this move down. We've lost the 200-day moving average, we've lost the 250, we've lost the 300. We are at a 3830 RSI. We are at the negative third ATR channel. I like how we went under it and back over it. 92% of prices tend to stop going down or bounce at the negative third ATR channel. So it was a good sign that we moved under and then we moved back over. There we go. So what am I looking for on Apple? Well, really, the only thing I'm looking for on Apple next week is a 30 RSI. We're 38.30. We had the FMOC meeting. Who knows? We might go down, but over time, buying Apple at an under 30, over 30 has always been a good approach. Let's take a look at the weekly, see if we can divine something from the weekly. Well, we had that huge rocket up, and now we're huge rocket back down. I could see Apple getting down here to possibly 145 or the -1 ATR channel here at 140. But who knows, kind of stuck in the middle of the value zone here on the week list. So nothing too great, but on the daily, an under 30, over 30 is what I'd be looking for. Advanced micro devices, my goodness, look at that. We did have an under 30, over 30 back here on 9/7, and it did lead to a bounce. We have come back down. We have gone under the -3rd ATR channel 3 times, under, close back over, under, close back over, under, close back over. What I'm looking for next week on AMD would be an intraday under 30, over 30, or a close under 30, over 30. Let's take a look at the weekly. Well, this may be a great trade, very similar to the NVIDIA trade that I took on the weekly. So if we don't go under 30, over 30, and we just keep going down, but on the weekly, if we bounce at the 200-day moving average, absolutely, I will buy AMD. If we have a bounce or an intra-week rejection of the 200-day moving average, we also have a double bottom bullish divergence happening on AMD. Here we have the low, deep red MACD bars. We rally to green. We're coming back down here to potentially test this low, and look, the MACD bars here, very shallow. So I'm seeing this a lot through the market on this second move down. The momentum, even though it looks strong from a MACD perspective, is not strong. So keep in mind, or I'm going to keep in mind AMD next week. If the daily doesn't pan out, if I don't get another under 30, over 30, then I am definitely going to be looking for AMD for a bounce or intra-week rejection of the 200-day moving average. Boeing, well, Boeing also down quite a bit. We're at a 34.95 RSI. I would be looking for an under 30, over 30 intraday, or close under, close back over. If we look at the weekly, you know, we've had this big move up. We've retraced back down. If we, on the daily, if we get an under 30, over 30, that would probably dovetail nicely with a 50% retracement of this move from a Fibonacci standpoint here. So yeah, looking for Boeing for an under 30, over 30. Bitcoin. Well, you don't hear me talk a lot about Bitcoin, but I do like this chart quite a bit, and this is symbol BITO. Here's the level of liquidity. I'm getting back to ITC mentoring stuff now. Here we have a low. We ran the liquidity. Then 3 days later, we switched to a bullish market structure. Well, us getting above this pivot after running the liquidity put us into the market structure. Now we have all sorts of gaps here. A gap from here to here. Well, after you change market structure, buying the dip, that's the correct move. We also have an order block here, the high of this order block, in conjunction with all these fair value gaps. So yeah, I am looking for one of two things. If we come down further, an under 30, over 30, but more likely if we head up, then we will have a higher low V2. A V2 consists of 3 bars. Here's bar 1, bar 2. Bar 2 went under bar 1. Now Monday, if we can close above bar 1's close here, in conjunction with the structure change to the upside, the pullback into the gap, the rejection of the order block, and MACD is positive, that's where I would get long BITO. So if we have a nice V2 on Monday, then I will be buying BITO, and I rarely buy Bitcoin. CCJ, Cameco Corporation. Well, this is one of the more bullish stocks. I mean, look, we're only into the value zone. Most of the stocks we're looking at were under the 200. But look, we had we broke the resistance here. We went into a nice uptrend. We've come back into the value zone, which happens so often. Well, it always happens because it's mean reversion, but we were above the 1 ATR channel. We moved up nicely here. Now we've pulled back into the value zone. I don't want to buy above value. I want to wait for the stock to come back in to value. I want to buy at value and sell above value. I don't want to buy above value and get stopped out at value. Makes sense? So we're in a nice uptrend here. We're having a pullback, which is to be expected. We are in the value zone. What I would really like to see for next week is to see some support, make sure that we don't keep going down, show that there's an equal amount of buyers and sellers to get some consolidation, and then look for a V1 or a V2 entry. And again, this is something I teach in my course. V1, V2 entries are really one of, it's really my bread and butter of trading. And by the way, in my YouTube channel, I have a free video there. Just go to the lessons playlist and V1s, V2s, and check that out. It's really, really good video, and V1s, V2s are just excellent. So for next week, if I could get another day, another couple days of sideways motion, then look for a V1 or a V2 entry. I would be buying CCJ, and I like it because it's very, very strong. Alternatively, if we came crashing down, I would also look to buy at the 200. Gold. Well, gold has just fallen off a cliff. As with the rest of the market, we're at a 35.14 RSI. What I would be looking for next week is an intraday rejection of the 30 RSI to get long, give me a good risk to reward ratio at a decent level, or a close under, close over 30. Alternatively, look at gold on the weekly. Well, the weekly did not hold the 200-day moving average. So next Friday, an alternative trade for me would be if it closed back above the 200, then I would get long gold on the weekly time frame. If it keeps going down and bounces at the 250-week moving average, I would also get long there. So for next week on the weekly, looking for a close above the 200-day moving average, I could get long on a weekly trade. Alternatively, if it goes down to the 250-day or 250-week and rejects it, I could also get long there. Alternatively, on the daily, if we get an under 30, over 30, I could get long gold there as well. All right, and that was GLD, by the way. Google, well, my gosh, how the mighty have fallen. Look at this extreme down move. My goodness. Google, G-O-O-G-L, one of the top companies again in the world. I'd rather buy this on sale than buy it at full retail, and it's on sale right now. It's 34.39 RSI. What I would be looking for on Google would be an under 30, over 30. That would be my entry signal intraday, or close under, close back over. Let's take a look at the weekly. Alternatively, if we do not get that next Friday, if we for some reason have a big move down, I will absolutely positively be buying Google on the weekly if we have a bounce, intra-week rejection, or a close under, close over. Again, here we go. Look at the double bottom bullish divergence. Here we have a low with deep red MACD bars. We rally into some green MACD bars. We have come back down, testing that low. Look at the MACD. MACD is very, very shallow compared to the first move. So this is, I see this over and over again in the market, that this second move down here has not come with the strength, the selling strength, as the first one. And the implication is that we're running out of sellers, and if you run out of sellers, you're going to go the other way to the upside. So again, on the weekly, if we do have some kind of bounce, intra-week rejection of the 200, I'm 100 million% going to buy that. And then on the daily, if we just have a under 30, over 30 on the daily, I will buy that as well. Goldman Sachs, holding up pretty well. We have not had the huge down move as we have in some of the tech stocks, so the financials are doing better. What I would be looking for on Goldman Sachs next week would just simply be a close above the 200-day moving average, position size for volatility, place my emergency stop 2 ATRs below, end of day stop would just be simply a close below the 200-day moving average. That's if it goes up. If it goes down, then I need another level. Well, it's 44.06. Most likely the level that I would be looking for on Goldman Sachs would be an under 30, over 30. IBB, well, very similar to BITO. Nice run on liquidity down here. This bar here turned, went above this pivot, turning this into a bullish market structure with the fair value gap from here to here. We did come back down. We are in that fair value gap. We also bounce off the order block, which is very good signal. Here's the order block, this down bar here before the structure change, and 121.60 was the top of that, and it bounced. Actually, you know, I bought Verizon and I bought Nvidia, so I didn't want to add too many positions, but this is a seriously good setup right here. If we were to come back down again, test this order block, some kind of V1 or V2 combination with that, I would really like that. But I do have some hopes for IBB next week because of the bullish market structure change, the pullback into the fair value gap, the relative strength of IBB. So just need some kind of entry, some kind of V1, V2 entry would get me long IBB. INDA, well, this one is something that I would be looking for a short. Again, this is back to ICT. Here's liquidity up here. We ran the liquidity to the upside. We came back down. We broke the market structure here, which turns this into a bearish market structure. Does that mean go ahead and short right away? No, but the market structure has changed to the downside. Now I'm looking for fair value gaps to short. And there is a fair value gap between here and here. So I could wait for a check back rally into there, and I would definitely get short there. Alternatively, we also have a big value gap from here, which is in between 43.88 and 43.13. I am going to be conservative and wait for a rally back up into the top value gap, because that would give me a better risk to reward ratio. So again, we ran liquidity to the upside. We had a big move down, broke market structure to the downside. Now I'm just waiting for a check back into this upper value gap, fair value gap, somewhere between 44.11 and 43.94. And if it does, I will definitely go ahead and short. My stop would be, my end of day stop would be a close above this high. Intel, well, as with the other chips, look at Intel. My gosh, just down. It's a $29 stock, unbelievable. We're $29.24. We had a V1 on Friday, not good enough for me to take. But very simply for Intel, if we could get above a 30 RSI next week, right now we're at 29.24. If we had a close under, which we did, we closed under 30 because it's 29.24. And then if we have a close back above, I would get long Intel. Looking at the weekly, we're at 27.52. We are kind of flirting around here with this negative third ATR channel. No double bottoms, bullish divergences, but I just like the location on the weekly of being near the negative third ATR channel, and on the daily of being close to the 30 RSI. A lot of volume came in on Friday. Okay, Coca-Cola. Well, I did have the losing trade on Coke with the bounce of the 200. Luckily took a little profit. Then I had to get out with the close under the 200-day moving average. Next week on Coca-Cola, look, we bounced at the 250-day moving average. We're at 33.68. So if I could get another rejection of the 250-day moving average, or if it goes lower, I would also play it off of the 300-day moving average, or alternatively, the best would be if we went under 30, over 30, and then also under the 300 and back over the 300. So really, that's what I'm looking for on Coca-Cola, would be an under 30, over 300, and ideally a rejection of the 300-day moving average on the daily. Let's take a look at the weekly. Weeklies at the negative 1 ATR channel. It did find some support last time it was in these areas. So that's what I'm looking for on Disney, is an under 30, over 30 in conjunction with a bounce or intraday rejection of the 300-day moving average. Lockheed Martin. Okay, well, I did have a stinker trade on Lockheed Martin. I bought here with this V1, got hammered here, but look, Lockheed Martin's relative strength is pretty strong compared to the rest of the market. Last time we were at the 200-day moving average, which is this black line, that was really where it found support before it took off. So now we are back here. Whenever I look at a moving average and it's under, over, then it's lost respect for the moving average. I like to look back and see, was that moving average respected last time? And it certainly was. right here. That offered you a great swing trade. And we are back down here again. We haven't touched it yet, but if I do get a bounce at the 200 or an intraday rejection of the 200 or close under the 200, I'll be buying Lockheed Martin. And again, the reason I like Lockheed Martin is because it is the relative strength of Lockheed Martin is much stronger than tech stocks and so forth. Southwest Airlines, LUV. My goodness, look at this, everyone. This is a train wreck. Really is a train wreck. So what am I looking for? Well, it's 33.23 RSI. Will there be some buyers that show up at the 30 RSI? We shall see, but that's what I am looking for as well. Looking here on the weekly, we may get down to the -2 ATR channel on the weekly, which would show some support. But what I'm really looking for next week on LUV is simply an under 30, over 30. We do have some support. The last time it came down here right about 35 kind of range. And if we get to an under 30, over 30, we will also be back down at this kind of 35 range with previous support back here in June. So looking for an under 30, over 30 on LUV. All right, let's go to MasterCard, MA. Well, MasterCard, my goodness. Again, one of the best companies. Look at this move down, incredible. What am I looking for on MasterCard for next week? Well, it's a 33.64 RSI. Did it go under 30 on Friday? We know we had a nice rally at the end of the day on Friday. Yeah, it didn't quite get to the 30 RSI, but very close. But again, what I'm looking for on MasterCard would simply be an under 30, over 30 intraday, or simply a close under 30, over 30. But I like that we did go under the -3rd channel and over. Again, we have another double bottom with the bullish divergence. Here's our lows, deep red MACD bars. Nice rally, went a little green. Now we come back down. We are lower than this previous low, right? With the double bottom bullish divergence. So it looks like this move down, even though it looks torturous and very strong from a MACD perspective, it wasn't even close to the selling strength of the first move down. So simply for next week on MasterCard, under 30, over 30. Meta. Okay, man, Meta, not so hot tamale. Look at this move down. What am I looking for? Again, deep dip buy of an under 30, over 30. We're at 34.96. If we continue lower, there will be, not for sure, but very often there are buyers that come in at that 30 RSI level. And that's what I'm looking for is an under 30, over 30 on Meta. On the weekly, we have a huge bullish divergence here. Again, here's a low, super red MACD bars. We rally into some green. Now we've come lower and we're at a 33.92 RSI. So, you know, one of the reasons I'm bullish on the market here is there's a lot of low 30 RSI readings on the weekly. Doesn't mean that it can't go lower. It can. But to have the confluence of the weekly bars being very close to the -3rd ATR channel and the dailies being so low with under 30, over 30s, that's why I'm bullish on this market. A lot of the bullish divergences, this move down showing the momentum, even though it looks strong, is not strong. The RSI readings in the low 30s, both on the daily and the weekly, and sentiment is so negative right now in the market. Everyone's bearish. Everyone's bearish. Well, when everyone's bearish is when I get bullish, honestly. That's how it works. When everyone gets bullish, I start to get bearish. And I like to buy stocks on sale and sell them. I like to buy them under value or at least at value, sell them over value. And again, Dr. Alexander Elder always told me, everyone loves sales unless it comes to stocks. They get scared. They don't want to buy. But if you look back in time, buying at the lows when no one is interested in stocks, you get the best price. Of course, you still need the correct setup. You need to position size correctly. You need to have your stops. But I'm quite bullish on the market at this point. And, you know, we have the FMC meeting next week. I mean, you know, the 3/4 75 basis point interest rate hike, which is most likely, really is baked into the cake. If we get a 1%, a full 100 basis points up, yeah, of course, the market is not going to like that. But the Fed does not like to surprise, and they've been telegraphing a 75 basis point rise. It is baked into the cake. Of course, what Jerome Powell says in the question and answer section on Wednesday will definitely have an effect. But, with FedEx going down, withdrawing their guidance, being down, what was it, 22% on Friday, is showing that these interest rate increase are affecting the market to the downside. Is that good news or bad news? Well, it's bad news, but from a Fed standpoint, if they see that things are slowing down, then most likely they will pivot quicker or not have to increase interest rates as often, or the amount of move that they're going to increase it. So in this case, bad news is good news in the market. All right, Microsoft. Well, my gosh, one of the best companies in the world. Look at this move. Look at this rejection of the 200-day moving average, by the way. Man, why did I not short this up here? I did short Tesla, but look at this. As soon as it got up to it, resistance, and all the way back down. Microsoft, one of the best companies in the world, is at a 31.32 RSI. I am going to be definitely buying Microsoft if we get an under 30, over 30 intraday, or close under, close back over. Let's take a look at the weekly. Again, weekly double bottom bullish divergence. Here's the low, deep red MACD bar, rally into some green, and here we are. And look, the MACD is very, very shallow. So I am definitely going to be looking for Microsoft on the weekly. If it goes under 30, over 30, I'd buy it. If it comes down here to the 200-day moving average, I would certainly buy it on the weekly, and on the daily, simply an under 30, over 30. Qs. It's interesting with the ICT, with the fair value gaps. Here is a little fair value gap here in between this bar. Sorry, let me get that one a little bit closer. There we go. There's a small, teeny-weeny little fair value gap that happened here before we took out this high. We came down all the way to it, and look, that's exactly where it bounced. Pretty interesting, isn't it? Pretty interesting. So we did bounce off the negative third ATR channel here. No trades here on Qs. I just wanted to show you the indexes. But we did come right to that fair value gap. That is where we bounced. We had a nice reversal on Friday off the negative third ATR channel, and we closed above the open, which is significant. If we look over on the weekly here, we ran liquidity. We changed market structure to the upside, and we're coming back down. Here is the top of the order block on the weekly, and that's right where we bounced and went up. So on the weekly, I'm bullish. I think we're going to go back up, but I'm wrong, and I'm wrong often. But on the weekly, if we bounce at the 200 million%, I'm going to buy that. And then on the daily, we did fill this gap and move back up. So on the daily, if we had an under 30, over 30, I would get interested. On the weekly, a move back down to the 200, I would definitely be super interested in that. Same with SPY. SPY's a little stronger than the NASDAQ, and we did not get down to the fair value gap here, but if we did get back down to this fair value gap in between 380.50 and 379.05, I would definitely be looking to buy there. In addition, we're at a 37 RSI. If we get down to this fair value gap, we're going to be in the low 30s. So if SPY gets down into the 379.05, 380 level, which is about 6 points lower, I will definitely be buying the SPY. Bonds, I talked about bonds last week. Still no position in bonds, but we've had this huge move down, but this is a falling knife scenario. But look, falling knife, but now the knife is kind of starting to stick. We're starting to consolidate. We're at a 34.41 RSI. I would be looking for one of two things: an under 30, over 30 on the RSI, or I would get long bonds Monday if we had a V2. Here, a V2 consists of 3 bars: bar 1, bar 2. Bar 2 went under bar 1, and then if Monday, we get a close above bar one's close, which is right about 107.97. So essentially, if we get up to 108, that would give me a higher low V2, and that's where I would get interested in TLT. And on the weekly, again, look at the beautiful double bottom bullish divergence. We have a low here with deep red MACD bars. We rally into green. We are now lower than this previous low. No red to be found. This is called the double bottom with the bullish right. Double bottom with the bullish divergence with a missing right shoulder. This is Dr. Elder's #1 type of setup, is the double bottom bullish divergence. But in addition, the missing right shoulder, there's no red. So I really like TLT here. I know it looks counterintuitive, but depending what Jay Powell says next week, bonds might catch a bid. So on the weekly, really, really love this. And by the way, on bonds, if I don't get the signal on the daily with the V2 or an under 30 over 30, on the weekly I could be getting it, because look, we're at a 29.51 RSI. We close below the 30 RSI. If we close above it, then it's a close under, close back over. I would buy that next Friday if it closed back above 30 RSI, especially in context of the double bottom bullish divergence. So I am actually quite bullish on bonds right here. Counterintuitive, I know, but again, I still need to have a signal. My signal for next week is a close over the 30 RSI on the weekly or on the daily if we simply get an under 30 over 30. USO, well, boy, oil has really come back down here, but I'm looking for one of two things on USO. Ideally, I'd like to see it move down, bounce at the 250. You see how last time we had a close under, close over the 250, and then it rallied nicely? Perfect. I'd love it to come back down, test the 250-day moving average. That's where I would get long. Alternatively, if we get a close back above the 200, that would also be a potential, but actually just, from experience and looking at this chart, I would ideally like some kind of intraday rejection of the 250, close under, close back over, or an intraday rejection of the 250. The dollar, UUP, okay. Well, I am looking at this as a short. Here was a liquidity level. We ran the liquidity level. We had a big pullback here, took out the first pivot to the downside. This changed the structure to the downside. After you have a structure change to the downside, then what do you do? Well, I am looking at shorting in the value gap here between, let's see here, and here is the gap. We've already come back into it. From here to here, this would be an order block here, the high of the order block. And then in addition to that, we have this big down bar. And if you have a big down bar and then rally back up into that, that would be a short position. And look, that's exactly what happened on Friday. We were above that halfway, moved back down below. So we also have, here we go. We also have the potential for a V2 to the downside. Here's bar 1, bar 2 goes above bar 1. If on Monday we get a close below bar 1's close, that would be a legitimate short entry signal. So I'm looking for a V2 to the downside on Monday for UUP, or alternatively, if we rally up higher, get to the top of that order block, I would be shorting UUP. So I'm looking for a short on UUP. Verizon, of course, I already bought Verizon. I told you that on earlier in the podcast here with the V1 and the bounce near the 30 RSI and the double bottom bullish divergence. If I was not already long Verizon, an under 30 over 30 would also get me long Verizon. And if we look over on the weekly here, we're at a 33.26 RSI. Again, if I was not already long Verizon on the weekly next Friday, if we went under 30 over 30, I would get long Verizon as well. And then last but not least, XLRE, which is real estate. My gosh, that is ugly, fugly. Really, really. We're at a 34.19 RSI. We went under the negative third channel, over the negative third ATR channel. That's a good sign. Next week, if XLRE went under 30, over 30, I would get long. Let's look at the weekly. Weekly also gives an opportunity for a weekend trade on Friday if we come back down, test the 200 week moving average. So anyway, I am bullish on this market. It doesn't mean that it has to happen right this second, but I think within a few days here, we are going to make some kind of bottom, but just a theory, folks. It's just a theory. I am wrong often, but I do think the Jay Powell FMOC meeting is going to bring some movement, obviously, to the market. But what I'm seeing here is bullish because it's so bearish. So I hope this was helpful, everyone. I did mention at the beginning of the podcast, I do teach private one-on-one lessons in the evening time. I love to teach. I just love to teach new students how to trade. I like to give them a skill that they can make money with for the rest of their lives. But the course that I teach, again, it's one-on-one. It's in the evening time via Skype, 5 sessions. Each session is 3 hours, so you get a total of 15 hours. I teach you step by step all 5 of the different trading approaches that I use. The course tuition is $1,750. I know it sounds like a lot of money, but it's worth every penny, everyone. Like I said, I have turned out so many great traders around the world. You're going to learn so much. We're going to become friends. So if you're interested, all you have to do is send me an email. The email is in the link of the description below of this video. Just reach out and say, hey, Greg, I'm potentially interested in taking your course. I'll say, great. Thanks for saying hi. I will ask, hey, if you have time, let's set up a Skype call. The Skype call is not a sales call. I promise you. I just want to learn more about you, your trading, what you're hoping to get out of taking the course. If you have any questions about the course, I want to be able to answer those. And then when we're done with the call, I'll never contact you again. If you want to take the lessons, you'll have to contact me back. So you don't have to worry about me hounding you for a sales thing, because it's not. But I just want to see if we are a potential good fit as student and teacher. So the email's in there. Send me an email, and I know you'd be glad you did. Secondly, I do have a really good online course available at udemy.com. The link is in the description of this video as well. I teach the deep dip by stock trading strategy. It's a great course. It only costs $12 to $15. There's lots of content in there. There's 9.5 hours of total video. There are 15 study guides. There's 26 videos total. And you are going to learn a lot from that course. I promise you. And we are in the perfect market environment to do that right now. We are in deep dip buy land. You heard me talk all day about in this podcast about the RSI levels, the double bottoms, the bullish divergences, all the stuff with the deep dip buy is happening right here, right now. So if you have time this weekend, click on the Udemy link, watch the course. It's fantastic. And then lastly, well, I guess 2 more things. Number 3, if you like today's podcast, I would really appreciate it if you could hit the thumbs up button. It helps to build the channel, helps to keep the channel around, lets YouTube know there's some valuable content here. There's a lot of people out there that could use help with their trading, and you could help me get to them if you could just hit the thumbs up button or leave a comment or share it on social media. I would appreciate that as well. And then lastly, if you could try to go out and do something nice for somebody today, it would just make the world a better place if we could all do something. One nice act of kindness to another human being would be fantastic. And then also, if you have it in you, if you could please do that for an animal, I would really appreciate that. Animals like act of kindness just like we do. So I always try to make it a goal every day to do 1 act of kindness for another human being and 1 act of kindness for an animal. And hopefully one day, if you need it, you're having a bad day, or you need help, someone will be there to give you an act of kindness as well. So I hope you have a good rest of your weekend. Please get out, get some exercise, do some charting, right? Watch ICT, really good. I cannot recommend it enough. And here's a picture of it over on YouTube. And I have nothing to do with this channel, just good trading approaches that I've been learning as well. And again, thanks to Ava for turning me on to the fair value gaps. And but yeah, be good, be safe, have a nice weekend, get some rest, but maybe do a little deep breathing, a little presence work, and we'll get ready for next week. But I am bullish on the market here. with the caveat, I'm looking for the examples that I just showed on the list that I just went down, looking for those entries, always keeping the stocks, but I am bullish. Next week, we'll see if I'm right or not. Okay, well, that's it. Take care, everyone. Appreciate you being here. Appreciate you investing your time. Hope it's paying some dividends for you. And on the way out here, have to run the U.S. legal disclaimer. So take care, everyone. And God willing, we'll talk to you next week. Thanks a lot. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.